2003-2010 style upturn. We are witnessing a gradual increase in the risk appetite among corporates and banks, which will lead to a capex cycle expansion eventually. Today, we have with us Mr. Sanjay Nair, who will be sharing his views on this topic. The topic is value accretive private capital strategies for the Indian economic supercycle. So Mr. Nair needs no introduction, but very quickly, he has over 38 years of experience in the financial services space, 25 years of which were with Citibank and the rest with KKR in India. Over to Sanjay. This topic is of special relevance to all of us as we enter the new financial year, and I'm very excited to hear his thoughts on this subject. Sanjay, over to you.
Hi, everyone. Assuming you can hear me. Sorry, I'm dressed like this because I'm here at a wedding, but privileged to be back with the IVCA and Renuka and Rajat. Thanks for inviting me. Look, I think it's extremely relevant to talk about this topic. I'm happy to sort of set the stage kind of in a kind of a fluid way, but I think looking at the agenda for the next 3 days, I think a lot of these things get addressed in much more detail. Over the last 10 years, private equity venture capital have brought in about 250 billion, and India is pretty much right up there as a destination for foreign capital, as a place to be investing money. And hopefully that'll be the same thing for our own local capital. And this sector is so critical right now, and even more so today than it was yesterday, because you provide the most valuable form of capital in a country that is generally deficit in terms of the saving investment gap. So just at a conceptual level, I think all of us are extremely, should feel good about the fact that we represent a very valuable form of capital. So that's number one. But to set a strategy for the next few years, I think you have to know what's going on in the world today, and what's happening in India is going to be quite important, because it's not going to be exactly what was happening for the last 5 years. I think the next 5 years are going to be quite different in terms of strategies and exits and returns. So to be able to address that, I thought I'd sort of break up my thoughts in a couple of compartments. One is, let's appreciate where we are today. This government has tackled COVID exceedingly well. Vaccinations are, I think, record-breaking. And frankly, I'm in Delhi today and I'm just seeing the traffic everywhere. It's like we're totally back to normal. So I think that's a lot of kudos to the government. The recovery path on the GDP will show up. Last quarter wasn't the best, but I would say getting to 8-9% on a sustainable basis has to be the aim. And I think the budget sort of lays that down pretty clearly. And it's also very important to note that as a country, our public debt to GDP is 90%. We import pretty much 90% of our energy requirements. And generally, therefore, we are supply short at a very macro level and quite prone to inflation. So if you put all of that together, the real way out of all of this, frankly, is self-sufficiency, whether it's of capital, energy, whatever. And secondly, getting onto a real growth path. So growth, I think, is the key word that is to be appreciated, both in terms of what we heard in the budget and what I'm going to quickly talk about. So the finance minister, I think, had a fantastic budget, and it's worth putting that into context, right? Every budget has to make some trade-offs. I think the three that I can highlight that she's made, from my perspective, are actually the right trade-offs. The first one was to bring the fiscal deficit down from 6.9 to 6.4 to 4.5, but not in a dramatic rush. So in fact, I think they've been quite okay with the fiscal deficit, both in terms of loosening it just adequately and not tightening it too fast. Because frankly, the only way we're going to spend our way out of this is that the government will have to do a significant amount of spending. Now, one could have debated that they should have given a little bit more towards consumption, but we have seen that consumption stimuli in the long run are structurally don't sustain unless the per capita GDP goes up. So rural consumption actually is held up pretty well. And this government has continued in the budget to support the same welfare programs as we had in the past. So I think the first trade-off is We could have said there could have been a looser fiscal policy. I think the finance minister has done a tremendous job in kind of a tightrope walk here to aim to bring it down to 6.4, which gives her adequate space to be able to spend, and hopefully the revenues pick up. So that's number one. Number two, consumption versus investment. I mean, anybody will tell you that this budget was all about investment spending and a massive pickup in capex. And I think that's the right trade-off, albeit it's coming from the public side and hoping, thirdly, which is the third trade-off, that the private sector does participate. So we had a choice: stimulate private sector investment or public sector. I think the private sector has all the makings of the stimuli they need. You've got tremendous PLI schemes. You've had the corporate tax cut. You need to see the private enterprises jump in to be the second hand to clap. I think the finance minister has done a good job to make sure that the capex expenditure goes up to a totally new level and a new benchmark, such that public expenditure continues, especially in infrastructure, and hopefully the private sector will participate with equal enthusiasm, as doing business in India has indeed become easier, and plus all the schemes and kind of incentives that are being given. I think it's up to the private enterprise to really kind of join the party here. At the same time, I think there's some trade-offs that the government will have to think very hard in the next few months. And I think it's all about financing. Borrowing is probably the easier way out, although I don't think we have space to borrow anymore. So frankly, it's going to be about asset monetization, a plan that has been extremely well laid out and presented by the finance minister, I think in October of 21. And I think that needs to get into action. And there is ample capital available both locally and foreign to be able to participate in those kind of programs. And that structurally will help you change the debt structure of the country. And second, I think you have to crowd in the private sector and crowd in private capital locally. Foreign capital right now has all the avenues open, very few friction points. Local capital, AIFs, is a decade-old story. There are certain frictions, and we'll talk about that. But crowding in the local savings into the real sector is the third most important thing that the government has to do. I think we all can say Atmanirbhar capital is very important for Atmanirbhar India, and I think we agree with that. I think the frictions will have to be resolved, and the announcement of an expert committee, actually quite valiantly pushed by IVCA as well, was a fantastic outcome and a statement in the budget, which means it'll get translated into a real committee. And hopefully the friction points can be removed sooner rather than later, so that the local savings from pension, insurance, high net worth families can be crowded in to really help bridge the saving investment gap. So I think we have to be cognizant of where we are today. I think we're in a situation where the country needs a lot of growth. Public sector is spending, private sector needs to spend. And that saving investment gap has to be bridged by both foreign and local capital. And local capital needs to get an upper hand right now to be crowded in. So where are we today in terms of just corporates and enterprises? Substantial amount of deleveraging has already been done, frankly. Okay, I think now is the time for growth. So it's new capex, mergers and acquisitions, rationalization of corporate structures, which is divestitures, spin-offs, buying companies. There is a whole infrastructure and inbuilt opportunity. And of course, there are some other opportunities like distressed asset sales. So I don't want to touch upon that today, but I would just say staying with growth, capex, M&A, and rationalization. This is a tremendous opportunity for private capital now. This is exactly what private capital is good at. For 2.5 decades, we have all bet a lot upon increase in alpha, a little bit in growth, sometimes alpha. I think we're at a point in time, we'll have to really build on growth. So I see 4 big changes from a private equity strategy point of view. Number one is you've got to prioritize growth. You've got to underwrite growth, and you've got to install growth, and you've got to install management teams that drive growth, and you've got to rationalize businesses that drive growth. I don't think we can necessarily bank upon increase in multiples as we go ahead. Second, I think you're going to have exit opportunities that are going to be far more capital market driven. given the fact that our equity capital markets are far more robust today than they were before. And we have seen some real exits by private equity and early stage investors through public markets. So I think that's the second big thing. The third one is the market actually has gotten very neatly classified into check sizes for all. There is the $5 to $10 million check size. There is the 25 to 50 million middle market firms. There's 100 to 250, and the 250 and larger. So it's actually quite neatly stratified, which is a big change over the last 10 years. Everybody is not killing each other and walking over each other in terms of crazy valuations. So I think we're in a very good space where there is a stratification of the market between local managers of different kinds and foreign managers of different kinds. And that's a great place to be. And finally, the respect for private equity and private capital is tremendous. I think these four things, when you look at them, what comes to my mind is there couldn't be a better time for private equity and venture capital. But just speaking from pure private equity perspective, as I said, growth is key, which means for all of us, identifying the right management teams, the right founders is always going to be number one priority. Underwriting growth, underwriting consolidation, and rationalization is going to be extremely important upfront. Third, while you focus on growth, you have to focus on the threat of disruption through digital. Got to figure that out upfront. Can't figure that out later. Renuka mentioned ESG, different strategies for ESG, and great governance and diversity of thought is number 4. Installing the right leadership in these companies to drive growth, I think, is number 5. And as I always say, do it quickly, don't wait too long. Getting public ready, to my earlier point, given that public markets are going to be a lot more open, getting public ready from your first year investment, I think, is number 5. And build the company on sound fundamentals while you're private is far easier than while you're public. So do that while you're private. And I would say the last one is exit with grace. Exiting listed entities or unlisted entities, what you leave behind for the next person, whether it's a retail investor or it's a strategic who buys it from you, extremely critical. That builds your legacy, and that builds also the comfort for the management team you're leaving behind. You can't have a management team or leave a financials where the other person discovers that the management team is gone and the financials are not so strong, or that a lot of cash has been taken out. So I would say number 7, to create the legacy for private equity in general and for the companies that you own and you invest in, to leave them in a shape that the buyer makes even more money out of that, I think is extremely important. So I wanted to sort of, just close with that. I don't think I have any great solution about what the strategies are for a super cycle in India. But I think India is poised for a super economic cycle, given some of these bumps. And these bumps that we are facing actually are points of inflection and opportunity, reforms for the government, which are a must right now. And for the private capital folks who are on this audience and the IVCA community at large, a great opportunity to build local managers, drive the changes that we need with the help of the expert community. And India is anyway a very welcome destination for foreigners. So if we get the macro right, I think the private capital is going to have a great time. But do keep in mind the 7-8 things I said. These strategies are going to be slightly different than the past. When you could invest and just get out, I think things are going to be a little bit tougher. You have to work much harder and think like a strategic when you're in the company rather than as a silent minority partner. So that's my few points, Rajat and Renuka, and thank you for inviting me.
Okay, the left mute, unmute button is not available.